I want to welcome everyone here today. As you all know, my name is Alexandra Alvarado, and we're with the American Apartment Owners Association. We have with us today Marcia Macbeth, who just did a quick introduction. She's the president of Shelter 1031, which is a 1031 exchange facilitator. She's been a seasoned real estate professional with years of experience across multiple facets of the industry, including being a licensed real estate broker. We also have with us Rick Gann, which some of you might know Rick's face from some of our previous webinars. He's going to be helping us out in the Q&A. I do want to just give you all a few housekeeping items. One is we are recording this webinar, so we will be sending it to you tomorrow with the slides, and Marcia and Rick's information will be in there as well. So definitely take a look at that tomorrow if you miss anything. And Marcia's not on camera today, but she is on audio, so she'll be able to also answer some questions and do the presentation. So please follow along, and we'll be in touch with you tomorrow. We'll also have Q&A at the end of Marcia's presentation, as I mentioned, so you can put your questions in the question box, not the chat. That'll help us to keep track of all the questions a little better. And with that said, Marcia, I'll let you continue with your presentation. Thank you so much for coming on today to talk to our group.
Thank you, Alexandra. And yes, I apologize for my technical difficulty in not having a camera that seems to want to work for me today, but I am happy to be here, at least with the audio. So before we delve into our advanced topics, let's just quickly review the 5 basic rules of a 1031 exchange. I'm sure you're all familiar with them, but quickly. First, to defer your capital gains taxes in a 1031 exchange, you must sell and buy business or investment real estate. This excludes property like your home or flipped houses. Secondly, you must use a qualified intermediary, also known as an exchange accommodator, who must receive and disperse the proceeds of your sale. Third, you must comply with 2 time limits: the 45-day deadline to identify your replacement property and the 180-day deadline to purchase it. Fourth, you must limit your identification of replacement nominees to either 3 properties or more than 3 properties, provided their total value is less than 200% of the sale price of your relinquished property. And fifth, you must replace all your equity and all your debt if you want to defer all your capital gains taxes. If you would like a deeper dive into these rules, you can find all this information on our website, shelter1031.com. Today, we are going to spend just a few moments covering each of these 8 topics, and then we will have our Q&A session. So please be sure to post your questions on your screen, and we'll answer them at the end of the meeting. Let's start with what happens when your 1031 exchange begins in one year and ends in another. As a reminder, you have 180 days to close on the purchase of your replacement property. But if you sell in the later part of the year, say November, you actually need to file an extension to receive your full 180-day deadline. This is because technically your 180-day replacement period is cut short by your tax filing deadline. If you forget to file an extension, not only would you have late penalties on your taxes, but you would also forfeit your 1031 exchange. In other words, the more accurate way to describe the rule is that your 1031 exchange period is either 180 days from the closing of your relinquished property or your tax return filing deadline, whichever comes first. Depending on the ownership structure of your property, your tax return deadline without an extension could even be in March or April. Now let's suppose you initiated an exchange in 1 year, kept the funds with a qualified intermediary, and then failed to complete the exchange in the next year. In some instances, it is possible to treat the transaction as an installment sale, which may allow you to report the gain in the second year. The details for complying with IRC Section 453 are outside the scope of this webinar, but if you want to learn more about this solution, Either talk to your tax attorney or contact me and I can provide more direction. Our next topic is reverse exchanges. In a reverse exchange, a taxpayer ties up their replacement property before they sell the relinquished property. This happens when an opportunity for a great property comes along before you have time to list and sell an investment property that you already own. To conduct a reverse 1031 exchange, you start by entering into your purchase contract and bringing in your qualified intermediary who serves as an exchange accommodation title holder, or EAT. As a side note, an EAT relationship is more expensive than a regular QI because the EAT is taking legal title to the property and doing a lot more paperwork, including creating a special LLC. Just as in a regular purchase, you put up the funds for the property, but technically the property is sold to the EAT, who holds it on your behalf. The closing date of your purchase marks day 0 of the IRS deadline schedule. At this point, you have 45 days to identify which of your properties you intend to sell. This, of course, is the opposite of a standard, quote, forward exchange, in which you identify the properties you intend to buy. You then have an additional 135 days to complete the sale of your relinquished property, at which time the sale proceeds flow back to you through the QI, and the EAT transfers ownership of your previously acquired replacement property to you. One obvious drawback of the reverse exchange is that you must have the funds to complete the purchase of your new property long before you receive the funds from selling your existing property. However, for the taxpayers who perform reverse exchanges, it has clearly been worth the extra procedure and expense to secure the property that otherwise would have been gone by the time they did a traditional 1031 exchange. If you ever find yourself in a potential reverse exchange scenario, Shelter 1031 is happy to set up an EAT for your transaction and answer any questions that you may have along the way. Now let's switch gears and talk about vacation rentals and second homes. We get a lot of questions from folks who own Airbnb type properties, but who also use the property for their personal enjoyment. The recurring issue here is whether their personal use of the property disqualifies the property from doing a 1031 exchange. Well, about 17 years ago, the IRS issued what's known as a safe harbor rule. A safe harbor means that if you follow the parameters of the notice, the IRS will presume that your property is a bona fide investment property rather than a disqualified personal property. In this case, the safe harbor has 3 basic requirements. Just remember the numbers 24, 14, and 10. First, you must have owned the property for at least 24 months before doing an exchange. Second, you must have rented the property to other people at a legitimate market rental rate for at least 14 days of each of the last 2 prior years. Third, your personal use of the property cannot have exceeded 10% of the days it was rented out each year, or 14 days, whichever is greater. The bottom line is that you can enjoy some limited personal use of your vacation property before selling it in a 1031 exchange, provided you have owned it for 2 years. I suppose it's possible to survive an audit of your exchange even if you didn't comply with these rules, but you would then have the burden of proving why the IRS should treat your property as a bona fide investment. This next topic is closely related to the vacation rental scenario. Another common question I get is whether a client can sell a rental property and exchange it for a property they ultimately hope to occupy. The short answer is yes. In fact, let's start with a property you once lived in and converted to a rental property. Most tax practitioners agree that after you convert your personal residence to a rental, you must wait 2 years before conducting a 1031 exchange. If your long-term goal is to buy your future home, You must operate the new house as a rental property for another 2 years before moving in. It is a good idea to follow all the best practices of rental ownership and make it very clear in your records that the property was purchased and operated as a legitimate investment. In some cases, you can combine a 1031 exchange with the Section 121 exclusion, which you can apply toward the sale of a rental property you personally occupied for at least 2 of the last 5 years. As you may recall, IRC Section 121 allows homeowners to sell a current or recent residence without paying tax on the first $250,000 of gain per spouse. In our combined scenario, a married couple can receive $500,000 of untaxed sales proceeds and exchange the remaining value without recognizing any taxable gain. Of course, this requires very specific timing of the sale so that your property qualifies as both a bona fide investment and a recent residence. It's a short window of time, but we see people do it fairly often. Another hot topic is seller financing, which has seen a resurgence recently since interest rates have spiked up. Many would-be buyers have been priced out of the lending market, which makes seller financed properties potentially more attractive. Most seller financing arrangements take one of 2 forms. Either the seller transfers the property subject to an installment sale contract, or the seller sells the property outright and holds back a loan, essentially acting as a private bank. The former option is popular because it allows the seller to spread the tax consequences over several years. But ultimately, an installment sale only defers taxes, rather than avoiding them altogether over a series of 1031 exchanges. Which brings us to combining seller financing with a 1031 exchange. If you have the resources to fund your buyer's note, you can achieve both an attractive option for your buyer and defer or avoid capital gains taxes. The first step for a seller finance 1031 exchange, after finding a willing buyer and negotiating the loan terms, is to draw up a note secured by a deed of trust, just as a bank would do. The second step is to ensure that the buyer's deposit is payable to the QI and make the QI a party to the loan documents. The third step for the exchanger is to contribute cash equivalent to the loan amount to the QI account, which the QI uses to acquire the replacement property. Theoretically, you could also use the note itself as a full or partial consideration for the replacement purchase, but practically speaking, it's not likely your seller would accept your buyer's note in lieu of cash. In the final step, the QI assigns the secured note back to the exchanger, who will pay tax on the future interest payments, but not on the principal payments. After combining seller financing with a 1031 exchange, combining seller financing with a 1031 exchange is a much more tax-advantaged strategy than an installment sale, but it obviously requires that you can fund the loan from your own liquid assets or another lender. Our 6th advanced 1031 topic today is ownership changes and dissolutions. I'm told that attorneys will spend an entire afternoon being updated on regulatory and case law changes regarding this topic, so this will only be a very cursory overview. However, knowing that there could even be an issue is half the battle, which is why I just want to raise awareness on this webinar. Like many 1031 situations, ownership changes often come down to a matter of intent. It's not enough to seem like you own a business or investment property. You must actually intend to own the property indefinitely for business or investment purposes. The problem with ownership changes and dissolutions is that they often provide evidence that an owner did not intend to own the property indefinitely. Again, without that intent, property will be treated as inventory, which does not qualify for a 1031 exchange. Please keep in mind, though, that indefinitely does not mean forever. Rather, it means that you acquired the property without a demonstrated intent to transfer or sell it in the near future. Indeed, the IRS may allow a taxpayer to sell a 1031 replacement property soon after buying it, provided the sale was not contemplated at the time of purchase. Conversely, suppose you and two partners have an LLC that owns a rental property. During escrow, you decide to dissolve the LLC and sell the property as three tenants in common. At the moment you acquired your 1/3 interest in the property from the LLC, you had already decided to sell the property. The IRS likely would disallow the 1031 exchange because the LLC was technically a different owner than the three underlying members. Thankfully, the IRS does ignore certain entities like a revocable trust, living trust, or a single member LLC. In other words, these are, quote, disregarded entities for tax purposes, and therefore the IRS does not distinguish between the person and the entity. Otherwise, the IRS will treat a business or irrevocable trust as a separate and distinct person with different intent than its underlying members or beneficiaries. The remedy for most 1031 related ownership changes is time. The more time that occurs between an ownership change and a 1031 exchange, the less likely that a taxpayer will risk having their exchange disallowed. In some situations, a 2-year hold period may be necessary to eliminate the risk of a capital gains clawback. Be sure to seek advice from a qualified attorney or a tax professional before engaging in a, quote, drop and swap strategy with your business partners. And always verify that your replacement property will be held in the correct title. After you work with an intermediary, like Shelter 1031, to complete a successful exchange of your rental property, there's a couple of administrative tasks for your accountant to complete. As part of your next tax return, you will need to file IRS Form 8824 and possibly 1 or 2 other forms related to a 1031 exchange. Similarly, if you live in California, Oregon, and a few other states, you will need to report your 1031 exchange to the state and possibly even your local government. Be sure to discuss your exchange with your tax professional and make sure he or she has all your transactional details. You or your accountant also may need to recalculate a new depreciation schedule for your replacement property. In a 1031 exchange, if you have not fully depreciated your relinquished property, you basically roll over your same depreciation schedule to your replacement, assuming you did not change from residential to commercial or vice versa. However, if you acquired more real estate in your exchange than you sold, either with additional cash or additional debt, you are allowed to start a new depreciation schedule for the additional improvements you acquired. Increasing your depreciation deduction is a common result for folks who invest in passive replacement programs with higher built-in financing than their rental properties. Put simply, higher leverage buys more real estate, which in turn generates more depreciation. Finally, I would like to touch on the latest trends in passive replacement options. Specifically, I'm talking about investment programs that are designed for folks who want to transition from actively operating their own property to passively investing in institutionally managed real estate. Delaware statutory trusts, known as DSTs, are the most popular type of program, and experts believe that roughly $7 billion of 1031 equity will be invested in DSTs this year. For those of you who are not familiar with DSTs, these are programs that qualify as 1031 replacement properties under an IRS ruling from 2004, in which hundreds of taxpayers reinvest their equity into a single large property, or sometimes a small group of properties, that are all owned by a trust. Investors are treated as fractional owners by the IRS and receive their prorated share on net income and appreciation, even though their names are not recorded on the recorded title. Roughly 40% of DST dollars today are invested in multifamily, with industrial, medical, and retail being the next most popular sectors. The Southeast, Southwest, and Central U.S. continue to be the most popular locations of DST properties. particularly Texas, Florida, Tennessee, and the Carolinas. Most DSTs come with built-in financing with an average loan-to-value of about 45%. And while the interest rate crept up along with everyone else, the institutions that sponsor DSTs are able to secure terms that are more favorable than what mom and pop landlords can get. From my desk, most of the DST loans I see have 10-year terms, usually with 5 to 10-year interest-only periods, and typically are fixed rate. Most of the DSTs pay between a 4 and 5% yield as a percentage of equity, though some deals pay as high as 6%. More interesting, I think, has been the shift from traditional DSTs to pre-REIT properties. In a traditional DST, after 6 to 8 years, the DST sponsor sells the property, and you typically just do another 1031 exchange, either into another DST or back into real estate. But in a pre-REIT property, you only do one 1031 exchange, and then later your investment is converted to units in a real estate investment trust or REIT. In just the last few years, we've seen some major institutional real estate firms enter the pre-REIT 1031 business, including JLL, Apollo, Invesco, Hines, and Brookfield. All of these programs follow the same structure. You start with a 1031 exchange into a small portfolio of properties in a DST. Then 2 to 3 years later, a REIT absorbs the property, and you exchange your interests in the DST for interests in the REIT. These REITs typically have hundreds, if not thousands, of properties diversified across sector and geography, with portfolio leverage between 30 and 40%. After a year in the REIT, you can redeem shares subject to the REIT's quarterly redemption limits, with the understanding that withdrawals are taxable. Today, most of these REITs pay a higher yield than the current DSTs, so you are likely to see a slight increase in your income after your 1031 investment converts to the REIT. We predict this year that half of all DST dollars will be invested in programs that are slated to convert to REITs, which is a huge increase from just a few years ago. With that, I have concluded the presentation on advanced 1031 topics. I have to make the disclaimer that we do not give tax or legal advice, so please consult with your attorney or tax professional, especially with regard to any advanced 1031 scenarios. And now
Thank
we will
you.
open it up to some Q&A. Thank you, Alexandra.
Yes, thank you so much, Marcia. You speak so clearly. It was very great to go through all that information. I appreciate it. We do have a couple questions that came in the Q&A, so all of you on the call, please put your questions in the Q&A. I also just want to launch a quick poll question while y'all are putting your questions in Q&A. Would you like to set up a complimentary consultation to help you create a tax deferral strategy that works for you? Obviously, we went over a lot of different topics, and so, it's always good to meet with someone individually to really tailor the strategy to your specific needs. So with that, I'll leave that up for a few moments. The first question we have is, can it be sold into family?
Oh, go ahead, Rick.
Well, I was going to say, when you're talking about, I'm assuming the question is, can you sell your rental property to family?
Yes.
And the IRS really frowns on related party transactions. And the reason that that's the case is because there's so much opportunity when you are transacting with family to have a structure where properties are not being bought or sold at fair market value, and tax that otherwise would get recognized has the potential of not being paid, or I mean, there's just so many situations where you can work the system. So you have to be very careful with related party transactions, and you have to ensure that ultimately the properties are transacting at fair market value. And so again, we're not giving tax or legal advice here, but you are setting yourself up for audit when you transact with relatives in a 1031 exchange.
Mhm. Yeah, that's a good point. So no friends and family discounts. The next question here is from Chris. Can I do a 1031 exchange by selling my rental house and purchasing a newly built home in a development that a large development company just built?
Yeah. I mean, the short answer is yes, because you're just, you're buying a new property. There's nowhere in the IRS rules that says that it cannot be a new build. Again, the intent, it always goes back to intent. Is the intention to buy this new build and have it as a rental. Long term, as we discussed briefly, if the intent is to occupy it as a primary residence down the road, then we go back to the 2-year rule that you must operate it as a rental for 2 years. But certainly, yeah, you can buy a new build.
Great. And to kind of go back to the basics a little, as far as what qualifies as the type of property, it's really, if I'm not mistaken, any kind of real estate, or are there exceptions to that?
You want to go ahead, Rick?
I'll jump in here. Yeah, and Marcia referenced earlier in the basic rules that, ultimately, when you're doing a 1031 exchange, it is for property that you owned for investment or business purposes. And most of the time, a property that our clients own, it's not even close to being a gray area. It's obvious because it's a rental property that it was held for investment. Where you can get into trouble is having property that you feel is an investment, but it's not an investment within the definition of the IRS rules. And the most common exception is what's known as inventory, is the industry term. And inventory refers to property that developers or flippers own that clearly is an investment. You bought a property, you flipped it, and then you sold it for investment purposes, but you didn't hold it for an investment. You purchased it for the purpose of turning around and reselling it at the time that you bought it. And so that is an example of a property that, even though you didn't personally occupy that property, you didn't use it personally, it doesn't qualify for a 1031 exchange because it falls under the category, under the definition of inventory, similar to developers who are in the business of buying tracts of land, but building on them and then reselling subdivisions. That's another area where, even though the developer might have held that land for a long time, when you bought it knowing that your plan was to buy it, build it, and resell it as inventory, that also typically does not qualify for a 1031 exchange. Other than those two exceptions, or getting into trouble because you're personally using the property beyond the safe harbor that Marcia described, any other type of real estate that you owned as an investment, held for speculation, or used for your business, all qualifies as 1031 investment or business property.
Hi, thank you for clarifying that. So we're all on the same page. Another question came in. The price of the new property, does it have to be the same or higher price than the previous?
Yes, to be fully deferred, the IRS rule states you always have to buy equal to or greater than what you sell. And this is on the actual sales price. I have clients a lot of times get confused. They think it's just on their proceeds, what they got out of it is what they have to reinvest. But no, the IRS looks at the sale prices. So you always have to keep in mind that you have to buy equal to or greater than the sale price of what you sold. There are some fees you can take off of the selling price to reduce that a bit. Biggest one being commissions, real estate commissions that you pay. So if you sell something for round numbers 950,000 and you had 50,000 in commissions, well, now your replacement requirement falls to 900,000. So there are some, but general rule of thumb is just always think you've got to buy equal to or greater than what you sold to be fully deferred.
Wonderful. Okay, Ed asking, I own a shopping mall in conjunction with a foreign company. I own 50% of the shares of the corporation that owns the mall. Can I do a 1031 with my shares?
No, unfortunately. And this gets back to the topic that Marcia was discussing with regard to entities. And often what you see in this situation is with without being aware of these rules, and I understand intuitively, it seems like you should be able to do this, but you if you co-own a property with inside an entity, regardless of whether the other party is a foreign entity or not, you can't sell that property and then just go exchange your half of the proceeds. Because technically, the LLC or corporation or partnership, whatever the entity is, that entity sold the property. And so that entity has to buy the replacement property. And you can't change horses midstream and sell a property as a corporation and then buy a replacement property as an individual with half the proceeds. That's I mean, that's just an automatic no. And so there are strategies to achieve what you want to accomplish. Unfortunately, like Marcia said, the answer comes down to time. And so you have to plan for these by dissolving entities, long in advance, or what we do more often is go ahead and move forward with an exchange and buy, for example, two properties, or buy a DST and another property, or buy all DSTs, whatever the entities, the replacement programs are that you want to invest in on the back end of your exchange. It really doesn't matter for the concept, but the idea is that you actually move forward in the exchange with your partners in the entity, and then come out the other side with some assets that are divisible. In other words, don't just buy one more property again, then you're back to co-owning a property. Buy two properties or a property and a DST or two DSTs, whatever. And then dissolve the entity, a year later after doing one more tax return, for example. And then you can separate the ownership of whatever was the replacement property so that the two parties that really wanted to go their separate ways as a result of that sale can do so. And that does require you having to sort of go along with that other partner, for maybe for longer than you wanted to. But ultimately, that strategy allows you to achieve the two things that you want to do, which is defer all of your capital gains taxes as part of that transaction, and then ultimately separate out. You just can't do it all at the same time.
Yeah, longer term strategy there. Okay, but still possible.
Still possible.
Interesting. Okay, Susan asking here, she says, I purchased a residential rental property through a 1031 exchange that has been leased to a tenant 3 years ago. I've decided to move into the property as my primary residence now. Is that allowable?
It is allowable, and there's no prohibition against moving into a property that you originally acquired as a rental property. Again, provided that you had the intent to buy that property originally as a rental property, that you, just like Marcia mentioned, that you followed all of the rules and practices that any person would normally do with a rental property. So there, if it was a bona fide rental property at the time. And then if you rented it out for at least 2 years, then you've met the requirement under the safe harbor that was published by the IRS. So you're in good shape. And it's where people get into hot water is they bought a property as a rental ostensibly, and then they move into it a few months later. And now the IRS is going to come back and in all likelihood disallow your exchange. So the IRS has provided very clear rules on how to go about converting a rental property to a personal property post 1031 exchange, and it's A, have the intent to operate it as a bona fide property, and two, rent it out for 2 years. And after you've done that, then you can move in.
Good. Okay. Good news for Susan. Next question is, can I buy two or more properties from the proceeds?
Marcia, you want to take
Of
that?
course, yeah, yeah. Like Rick had just mentioned, you can buy uh, up to 3 properties that on your property identification form that you would submit within the 45 days of close of your relinquished property. You can list 3 properties of any value, and that can be a combination of, like Rick said, a DST and a condo or a rental property or 2 DSTs, whatever the combination of 3 is fine. If you go over 3, that's when the 200% rule kicks in. And I don't want to get too much into the weeds, but that's just says that if you list 4, 5, or 6 properties, the total value of those properties cannot exceed 200% of the sale price of the property you relinquished. But 1 to 3 can be any value, and that's perfectly fine.
Great. Okay. Good to have options, especially in this real estate market. Also, Sandeep asking, can the property be purchased outside of the US for a 1031 exchange?
No, very specifically, the IRS makes a distinction between domestic and foreign property in a 1031 exchange. So any domestic property is like kind with any domestic property, and conversely, any foreign property is like kind with foreign property. But if you started by buying a rental condo in Cabo San Lucas, and now it's appreciated and you want to sell it and do a 1031 exchange, the whole world is available to you to replace that property except the United States. So you once you have a foreign property, you have to replace it with foreign, and same domestic and domestic. Why? I have no idea, but that is the rule.
Okay, next question from Isidore. Can you talk about mortgage boot, i.e., what are the rules?
Mortgage boot, I'm assuming that what you mean by that is what I mean by that. And so mortgage boot typically means that you bought a replacement property, and in the process of your exchange, the debt that you ended up having on your replacement property was less than the debt that you paid off on your relinquished property. And as a result, ultimately, you didn't buy as much real estate as you sold. And so the difference, if in other words, if you reinvested all of your cash proceeds that came out of your sale, but the new loan that you have on your replacement property is less than the loan you paid off, the difference is taxable, and which is okay. That doesn't mean you can't do the exchange. You still did a 1031 exchange, but to the extent that you didn't replace all your equity and all your debt, you are going to be taxed on the difference. And that can be as high as 28.8% federal, and 10% on roughly in state tax. So you can get close to 40% combined debt. If it's a small amount, you're probably not going to hit those numbers because it's based on the total, the bracket that you're in as a result of realizing that gain for that tax year. But on a larger transaction, if your mortgage boot was a couple $100,000 and it knocks you up into the top tax bracket for that year, then in California you could have close to a 40% combined tax on that boot, which is why we go to great lengths in our firm for folks who are investing in passive replacement programs to put you into deals where you don't have that problem, so that the investment program that you're buying has at least as much loan to value as the property you sold, so that you can replace that debt and not incur any quote mortgage boot.
Yes, that is a painful price to pay, especially with the state tax, depending on what state you're in. So thanks for clarifying that. So someone asked about the recording. So we are recording this and we will be automatically sending it to everyone who registered today. So keep an eye out on that later today or tomorrow. I'll be sending that out to everyone so you all can rewatch this if you came in a little late. We'll also give you the slides and everyone's contact information here as speakers. You're welcome, Lynn. So far, I haven't seen any other questions come in through the chat. You all did a great job of answering the questions we did get. I will say if you all do have questions or you think of some maybe specific situations after this, you can reach out to Rick and Marcia. I'm going to include their contact information in that follow-up email as well. So keep them as a resource, bookmark their information. They're a great resource to have if you need help with anything related to tax deferral strategy here. So be sure to reach out to them. You're welcome, Lisa. Any closing comments you'd like to add, Rick or Marcia?
No,
Well,
oh,
go
go
ahead,
ahead.
Marcia.
Uh, I just really appreciate the opportunity to speak with y'all, and hopefully we can help you in the future and make sure we keep you from having to pay any more taxes than you have to. That's the goal.
Yeah, absolutely. I like the sound of that.
And
Um,
Alexandra, I just want to point for everyone on the call, Marcia is your go-to person to do any 1031 exchange. Our firm, 1031 Capital Solutions, for those of you who don't know me, Alexandra has me on, thankfully, frequently. And I feel like I probably have a lot of folks who've seen my face on some of these webinars. Our role is to help you with a potential passive replacement program in your 1031 exchange. So there's your qualified intermediary is the one who's handling the funds regardless of what you invest in. And I'm your resource to the extent that we can help you retire from being a landlord and ultimately invest in a passive replacement program. So just want to make sure everyone knows who's who on the call.
Yes, thanks for
Yeah.
clarifying that. Rick and Marcia, y'all make a great team. So definitely reach out to them if you need help with that any really question there. You're welcome, Ed. Lots of thank yous coming in. And so we will send everyone the recording. I hope you all have a wonderful day. And in the meantime, I think our next webinar will be actually we're not having one next week. We're having one in 2 weeks. So we'll have some more information for you on that also in the email. All right, everyone. Marcia and Rick, thank you so much for your time today and all the great wealth of knowledge that you've shared with our members. Really appreciate it.
Thank you, Alexander. Thanks, everyone.
All right, everyone. Take care. Bye.